The hard part is, for the people at the bottom, it's not good.
Today, Mark Yusko discusses concerns about the US debt crisis that has contributed to the ongoing sharp sell-off in the Treasury market we've seen in the last 2 months. He points out the genuine concern from investors that yields are surging due to the efforts of activist traders known as bond vigilance, who aim to drive interest rates to levels that would compel the US government to address its runaway deficits and debt. Yusko says, if these fiscal challenges are not addressed, there is a major risk that the nation's financial situation could reach a breaking point, leading to some form of default, wiping out millions of people. Recently, during a series of Treasury bond auctions, there was a noticeable decline in investor demand. Strategists say this trend may signify an increase in yields. Just a few days ago, the United States conducted an auction for $20 billion worth of 30-year bonds. However, dealers were required to absorb a larger portion of the sales, at 18%, which exceeded the typical 11% share. This phenomenon follows a pattern of weak auctions in the past week for 3-year and 10-year treasuries. Yusko believes we're headed for a dark winter economically in the last part of 2023.
For the people at the top, they don't really care. They're good. The people in the upper half, they'll be fine. It is really hard for the people at the bottom. And look, we've all seen pictures of the Great Depression, the bread lines and the Dust Bowl. And for the people at the bottom, it's super hard. And if you look at the pictures of London in the 1860s, right? The people at the bottom, it's hard. But the country moves forward and moves on. I think inflation has peaked. I think we're heading back down with one caveat. If this skirmish, and again, I don't mean to your point earlier, prayers and hope for all the people impacted by this. I can't imagine what's going on and having to move and flee from bombs and I can't imagine. I've never experienced that. So I'm not trying to minimize, but right now it's a localized. Well, it's fine. We'll call it a war. It's not a skirmish. It's a war. It's a full-fledged war, but it's in a small area. But if it expands to the region, oil prices go up a lot, like a lot. And if that happens, inflation short-term goes up and economic growth comes crashing down. And in that scenario, I think your point on Janet loses control and she gets stuck trying to thread that needle and people call and we're at 6% on the long end in 5 heartbeats. So, there was a guy literally, I think right after we recorded the show said, I'm all in long bonds, 84.04 on the TLT. Damn, that's brave. And he's been right? It's up 3.5%. That was a good trade. Most people believe, and I think that's why wars are started, that war's good for the economy. It's good for stocks. And it's good for GDP growth. Well, it definitely is good for defense companies. It's definitely good for auxiliary businesses that support the war effort. And historically, it has been good for GDP growth. And historically, it actually has been good for the stock market. I fear in this case, where an expanded Middle East conflict would have such a deleterious effect on oil in a time where oil's still really important and where we don't have the strategic petroleum reserve and all kinds of other challenges. I just think it would catch people off sides, and I think we'd end up with the 2022 kind of redo. I could see a down 20% in equities easy. You'd lose at least that in your long bonds. Maybe actually you'd probably lose more like 30%. And it'd be ugly. And the other problem is liquidity dries up, right? Because you got this commitment, to shrink the balance sheet. Well, I think they'd have to throw that out the window. I do. Because at the end of the day, there are no buyers. So the buyer last resort has to be the central bank. And that, my friend, is what Paul Tudor Jones said. That'd be good for gold and good for Bitcoin. And I love how I like Bitcoin. It just doesn't matter. No one borrows at Fed funds. Like the average car loan, which is a crazy stat, it's like 17%. It's like, no, there's all these zero loans. I'm like, yeah, rich people get zero, but the average person is not getting zero rates. I mean, they're paying double. I heard car loans can go all the way up to 29%. We have currency devaluation, right? That's what we have. We created way too much currency, and the Fed's trying to fix that. I actually give credit to Jerome Powell, who might be the only person who isn't in the bad actor group. Right?
I feel like he's deserved credit.
He literally is independent. I think he means well. I think he's not part of the BlackRock, Goldman, Treasury Secretary, like billions cast. I think and you saw it. He's trying to run off the balance sheet. He's trying to. He got M2 negative for the first time in 100 years because he realizes Kelton was wrong. Right? You cannot create unlimited money with no impact. That was never a good idea. That was Krugman-esque. That was not smart. And I applaud them. But it did create currency devaluation. And it meant the price of everything that people need, housing, shelter, food, transportation, went up a lot. Not because those things got better, because the money got worse. And to your point, what is the only response when things get really ugly? Print more money, right? That's the only way out. And I mean, and it's just the law of large numbers, right? We created $500 billion in national debt in the last, 3 months? $500 billion? I mean, and someone put up, it took, I don't know what it was, 100 years to get the first $500 billion, and then we did $500 billion in 3 months. I mean, the only thing that makes me feel good about that is the opportunity in data, where I think we talked about this last week, right? That from the beginning of time to 2003, 5 exabytes of data were created.
Yusko discusses the troubles facing major banks and the role of short sellers in the market. He argues that they're not causing the problem, but benefiting from the asset liabilities, which will lead to a decline in price, further showing that the industry is in trouble.
Long-term is going to be the issue that there's not enough buyers, and there's this really interesting problem. So we've alienated our formerly largest buyers of treasuries. The Russians, the Chinese, Japanese, even the Germans and the French, and pretty much pissed off everybody, Saudis. And so who's going to replace that? Here's a crazy thing. If it weren't for Tether and Circle that own $90 billion of treasuries, rates would be in really significant pain right now. And so, and I think the point you said that Andy and the guys were making was that the mix of short duration to long duration is really important, right? Because if you have too much short duration, you're forced to refinance more often, obviously. And if you have to refinance into rising rates, that causes a death spiral. And what's really odd is we had 0 interest rates on the short end and kind of 2-3% on the long end for a decade almost. Wouldn't you, if you were really prudent, have hit that bid and pushed them all to the long end? Like issued all 30, 40, 50, 100-year bonds? Why weren't we issuing 100-year bonds? But no, we kept issuing T-bills. And I think we're at the highest level, is that right? The highest level of T-bills to T-bonds in history?
Yusko disagrees with the argument that fractional reserve banking is a fraud, as it plays an important role in pooling risk and creating wealth and innovation through funding businesses and asset ownership. Yusko also argues that gold has traditionally been considered money because it exists as an asset that is not tied to any liability. However, he believes that Bitcoin may become the new form of money, as it is not tied to any underlying asset or liability either. This is especially relevant now, as the US government printed half of all the money that had ever existed in the country's history in 2020, leading to a devaluation of the currency. While JP Morgan may be manipulating the price of gold, Bitcoin has been growing in value due to its limited supply and global demand. What do you think about the latest interview with Mark Yusko and his prediction for the volatile banking industry? Comment down below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.